back to the original question I have before we get into the larger picture of, saving, financial protection, investment, retirement, some of the things that are very relevant to this audience on a sort of permanent basis. I'm going back to the question we have right now. This is a prime example. There's been a lot of news flow in terms of geopolitical risk, as well as the kind of scenarios that could be played out when it comes to the current situation, when it comes to India and Pakistan, okay? I'm just saying. A few months ago we'd met when there were 3 state elections. We're also running up into into general elections. Just tell me, Feroze, what are the kind of concerns you feel that your H&I investors repeatedly express to yourself when it comes to this kind of uncertainty that can come into people's sort of mindsets when it comes to financial planning? Because at the end of the day, this is their hard-earned money. They have the same concerns you've talked about: saving, investment, passing on to generations. So what are the kind of concerns that you feel H&Is have, and what are the ways in which you address them?
Correct. See, uncertainty is going to be a part of life. You have to embrace uncertainty, because uncertainty is what makes the money. Fixed deposit don't have uncertainty. They don't create the wealth they should. They don't create wealth. They safeguard your wealth, get you some nominal return, which is of course a good objective to have. Uncertainty is something which you have to embrace and learn to live with. But what is important is, do you have a strategy? If you have a strategy, if you don't have a strategy, then these are going to be very, very troubled waters to fish in. If you have a strategy, you will be safer. In a bad year, like this financial year, which we are the fag end of, is not a great year. Equity has not done well. Debt market has not done well. AAA rated companies have gone bankrupt. Right? You have election on the path. Right? So these are all maximum uncertainties possible. In a year like this, if you had a reasonably good strategy with a plan A, with a plan B, with a plan C, you can't go with only one plan. Market will do well. See, I would go wrong, you would go wrong, BTVi will go wrong, TV18 will go wrong, all of us can go wrong. You have to always plan for plan A, and you should have a plan B. Anybody who has had a strategy, in my opinion, has in a bad year not lost money, made 3, 4, 5%. Somebody who has implemented strategy completely, and some of them would have been sitting in this room because they would be our clients, they would have made 6, 7%. This year, in a bad year. Is it great return? Of course not. But in a bad year, if you don't lose, and if you have head above water, then when the good year comes, you will make up for it. But in a bad year, if you lost 20%, then you are starting from 80, not from 103, 104. So what we do is every year we audit all Anand Rathi's customers by one of the big fours. Okay, I can't name those big fours. One of the big 4 audits our average customer's return, which has my good advice, which had my good deeds, bad deeds, mistakes. So the return comes to about 4-5% aggregate. I am not very happy with the return, but I am happy that in a bad year, if I am this, then when the good year turns around, then you will make your 17-18% and get your average. So point 1, if you have to embrace uncertainty, you will need a strategy, whatever be that strategy. If you don't have a strategy, and if you have just been buying products from different people, sometime real estate, sometime equity, somebody says buy this insurance policy, then you don't have a strategy. You have created a bouquet of flowers which don't have a reason why they are there in the bouquet. Okay. Right? So that's the best way. Having a strategy is the best way to traverse these tough times. If you don't like my strategy, have another strategy, but always have a plan A and plan B. Plan A is when you go right. When you yourself go wrong, plan B should help you. So you should always create a portfolio thinking that you can also go wrong. Most advisors, I also 10 years back fell for this trap when I used to work for ABN AMRO, that I will always go right. Then with great difficulty, my ego was bashed enough to say that I will go wrong also. Then you have a plan A and plan B. So that's a very good way to traverse this.
Okay. So fair enough, and we'll get into, and this is, by the way, the typical kind of juncture at which one would expect after we've finished our discussion for our audience to come back with questions. The question I have for you, Feroze, is also about this whole idea of financial protection, which is very important, versus growth, or perhaps together with growth, because those are two very important concepts. I often find that I'm assuming investors struggle with that, because on one hand there's this prospect of growth and strategy, and on the other hand there is this idea of financial protection. So how would you sort of talk about those two concepts going forward?
So one is, like Fatima's question is very valid. One is growth. How do you strike a balance, right? You don't want to grow so fast that when tide turns, you lose a lot of money. So there has to be a balance. That's why it is critical to expect a fair return, not too high, not too low. 15% in our opinion, mathematically provable, is a sensible return. I meet some people who say, no, yaar, I make 20%, I make 25%. Then my question is, for how long? If 20-25% you could have made for 30 years, then why is Warren Buffett so popular with 22% return? So it is not very easy to consistently make that. So you should have an optimal return, 15. Protection, when it comes to protection, use tools which are available to you, which you might not know. For example, in a situation like today, which comes every 5 years, there is a general election. If something goes wrong, markets fall 10, 15, 20% in a single day. How can you protect yourself? You can create a 4-month strategy. How many months? 4 months till the election, to make sure if election goes wrong also you don't lose money. But if election goes right, if market went up 30%, you can make the full 30%. What is the strategy? I just executed it today for one of my clients. Yeah. He said that I don't want to be worried about election. I want to change my strategy for 4 months so that I can sleep peacefully. There are strategies possible in finance. For 4 months, you protect your downside and take all the upside. How is this possible? It looks like a lacuna, but you have to go through your strategy to it. So protection is very critical. Protection are 2 layers. One is long-term protection, one is event protection. What I gave you an illustration is protecting against some event which you don't know the outcome and it is actually important. You cannot have a country where the governance is not stable and the country grows perpetually. It is good to see people tell on television that, yeah, we will grow irrespective of governments. Governments can be party spoilers if there is a stalemate. So I respect general elections immensely, because after 2009, right, if you say general election is not important, in 2 days it went up 35%. Of course, it is an important element, right? And in the last 5 years, Nifty has moved up 25%, 30%. So that's the kind of 2-day return superseded the last 5-year return. So general election is a very important event. So you have to protect yourself against events. You have to protect against yourself against long term. How do you do that is a part of strategy. So every 5 years, you might want to see whether you want to go through the speed breaker smoothly or openly, but it should be a strategy.
Okay, before we get into the elements that go into investing, and this will go back to the first point you made about getting an overall snapshot of a portfolio, I want to just focus on the kind of realities that exist with the retirement planning when it comes to HNIs, as well as passing on that wealth that you're talking about. In our previous interactions, we've talked about the next generation really being part of the kind of driving seat that you need them to be part of in terms of passing on wealth, in terms of wealth regeneration. How are HNIs who have planned for retirement, who may perhaps be very comfortable where they are, but are still concerned about wealth erosion, approaching this whole issue of wealth, passing on of wealth, ensuring that it's being handled responsibly and within a way that actually preserves the kind of capital that they had passed on to the future generations?
Correct. So if you are an HNI, it is most likely that you will not be able to spend all the money in your lifetime. You will leave a legacy for people and you will not be able to spend that money. If that's the case, one is to send it very cleanly. That's what we spoke of. But protecting that money becomes very critical. I don't want to, from 5 crores, I don't want to come to 4 crores. So if you, now for example, the strategy which we adopt, we measure it, and you should, the reason why I'm saying this is, irrespective whether you ever become or you already are an Anand Rathi customer or not, you should ask this question, saying that what do you mean by risk? Now for example, we have devised a strategy which says that in every 120 years, 3 years you will lose capital. Statistically, out of 120 years, you can lose capital for 3 years, statistically. Is that acceptable risk? I ask this question to the client. If he says, yeah, this is acceptable risk, yeah, 120 years, 3 years negative is okay. For me, it is acceptable. For you, it might not be acceptable. You want safer. That comes the strategy. But ask for a risk measure. Now, in the same strategy, it says that in every 18 years, there will be 3 years where you make less than FD return. Okay, in 120 years, 3 years you will make, your capital will also go down. So, that's a very, very sensitive topic. I don't want to lose my capital ever. Yeah. Right? There is that same strategy says that in 18 years, there will be 3 years where you will make less than FD return. Are you prepared, sir or madam, is the question my representative needs to ask. Yeah. If you are comfortable with that risk, you should embark on that journey. I think these are sensible risks to take. If they are supposed to be doctored downwards, then you do some changes in the strategy.
So, according to what you're saying, there is a lot of mathematics that is already maths that you can actually use in structuring portfolios, right? And tell me a little bit more about how you actually use that, because we've talked about the mathematics of risk briefly, but what is the kind of mathematics that is involved in the construction of portfolios, given the kind of factors that become very relevant when it comes to bringing a portfolio to an Anand Rathi, for example, versus, I guess someone else. I mean, I just want to understand how you're doing this differently, given the kind of competition that exists.
See, I would not call it differently. Yeah. We are just following the basics. Okay. See, this probabilities which I told you in 120 years, 3 years could be negative is not invented by Anand Rathi, fortunately. Yeah. The propensity for it to be wrong if I invented it was greater. But some great statisticians invented it 150 years back, a distribution they created for me to use today. But unfortunately, because we are only marketing, as an industry, we are more marketing than finance. If you use finance, then you will create it mathematically. So I would not want to claim credit to this whole mathematical construct. Statistics has enough tools given. There are 4 layers of mathematics. I will try and make it simple. The back end of how a portfolio gets created. You need 4 layers of mathematics. One problem is that advisors have this big problem. I used to have this big problem. When the market does very well, 99% of my friends, my journalist friends, my other colleagues in the industry will say market will do even better. So because 99% are telling me, I start believing, yeah man, it will do very good. In January 2008, I fell prey to the same syndrome. Everybody was saying it will do well, it will go up. So I started believing that. So you cannot rely on my judgment or my neighbor's judgment. You have to rely on mathematics. So there is a formula you can create which says that when the markets go to extremes, it's very easy to identify extremes. Human judgment should be kept in a box and mathematics should take over. Okay. So you create an index. Now for example, we created an index. That index, every time it touched 170, every time that index touched 170 in the past, next 3 years return were very bad. So now again if it touches 170, I will say Feroze's judgment is useless. It has touched 170. Every time it did that in the past, the next 2 years, 3 years returns were negative. So what will I do? I will dispassionately say that I have to get out of equity. So don't rely on human judgment in extreme situations is the first formula. You need to have an index to take over human judgment during extreme situations. Like in January 2008, everybody was saying it will go up. Then it came down from 21,000 to 8,000. At 8,000, everybody said now it will become 0. Right? But the index told that now there is nothing to worry. So you should use at least a mathematical formula. I am not saying this mathematical formula will be best. It will be better than human judgment. I can vouch for it.
Okay.
Will it be the best formula to manage your money? That is the first formula, mathematical, you need to have. Second is how much you put in big companies, how much you put in small companies should again not be on judgment. It should be on relative attractiveness. I'll tell you. See, there are bigger companies like the Infosys, the TCS of the world. They are very big companies. There are also smaller companies which are now budding. Like Anand Rathi is a very small company, right? We are 2,000 crore market cap. We are a 2,000 crore, 2,500 crore valuation. That's a small company. Infosys would be a few lakh crores. So what happens is, which company, which type of company should I be in now? Should be not human judgment, it should be mathematics judgment. Like last 1 year has been very bad, extremely bad for small companies. Yeah. Has been very good for big companies. Big companies have done very well. Small companies have done very bad. Could the formula have identified this extreme situation? The answer is yes. So if you go back on the interaction which we had on BTVi, 1st January 2018, I would have said mid cap, small cap, now you should not touch at all. It was not my foresight. It was the mathematics foresight which says now it is very expensive to be in the mid cap, small cap category, right? So you should, allocation of what kind of companies you need to have, what kind of mutual funds you need to have should be mathematical driven. The third level of mathematics is a formula which won a Nobel Prize, which is the only mathematical portfolio creation formula which won a Nobel Prize, which is called the Markowitz Theory. That's the third formula. I will not get into the detail, but if somebody won a Nobel Prize, I'm sure I can use it and be safe, right? I'm sure I have not won one, and I don't think in this lifetime I'm going to win. So I will borrow the concept and use it for my client's benefit, right? The fourth level of mathematics is the biggest disadvantage. Quite a few clients say, this is past performance, yaar, Feroze, tell me future. So fortunately, one more person won a Nobel Prize for future projection called Mr. Monte Carlo. Okay, and I'm telling you these just for you to do Google homework, that mathematics has gone so much ahead and we have not used it, we have left it in the books. There is a guy called Monte Carlo who created a simulator which can simulate. Like you today go in malls, you sit in a simulator and they take you through a roller coaster ride without being on one. So he created a simulator which can simulate the next 200 years, 300 years and try and see what are the new risks which it can emerge. That's called the Monte Carlo. So these 4 layers of mathematics is a reasonably better way. I am still not claiming that is the best way, and if we find a better way, we will adopt that, but this is still significantly mathematical than human judgment. And that's where artificial intelligence can help people protect themselves during bad times and progress better in the good times.
At the beginning of this conversation, you talked about how it's important for investors or clients to have an overall, a really realistic picture of what their overall net worth is all about. So it's not just about, a certain amount that is under AUM with one particular manager versus AUM with another manager versus my property versus another property that perhaps is not liquid. What is the really most brutally honest way of evaluating one's wealth, and how does one actually look at cash flow as an issue when it comes to that particular portfolio? What's an ideal picture for any of us, especially the ones in this audience?
Correct. So, firstly, I urge each of you to draw a balance sheet. Companies make a balance sheet every year. We should write down every asset you have. So, we, in fact, at Anand Rathi, don't like to give advice unless we see the full picture. Okay, so we have a format. Please put all your assets in that format. You will at least know, because I meet some people, they say I have 3 crores. Then I ask them to add this, I ask them to add insurance policies, I ask them to add PPF, then I ask them to add their small land parcel. Then they get to know, oh, I am actually at 8 crores. When you put all of it, when it is out of sight, you will not be able to apply management. So please draw up your balance sheet. In fact, I update my balance sheet once a month and see how I am progressing. Every month I have a target of where should my balance sheet be. Where am I today? The difference is noted. If you ask me what was your balance sheet in the year 2011 on this specific day, I'll be able to tell you, because that Excel sheet has monthly updations. So that gives you a fair idea of what is my balance sheet. Then after you draw the balance sheet, you say, if I make no changes to it, where will I reach? If you are happy with where you reach, then make no changes. If you are not happy with where you reach, then you should make changes, right? So drawing up balance sheet is very critical. And once you draw a balance sheet, there's more clarity in this process of wealth management. After that, you might give if you're doing this exercise with Anand Rathi, after that you give only 10% of the money to Anand Rathi, I'm okay. But at least do the balance sheet.
Interesting you bring that up, that somebody actually comes up thinking that they have 3 crores, but they actually have 8. Let's talk about the reverse scenario, where they think that they have 8, but they actually have 3. Okay.
Wow, wonderful.
Because, I mean, I don't know if, I don't have anywhere close to crores, but that's probably going to be my scenario someday. And it'll be like in much a fraction of that wealth. Part of that comes from this whole idea of real estate.
Correct.
Real estate wealth, right? And I'm not quite sure what the scenario is like in Chennai. You can educate me on that. And I'm sure your RMs have a lot of lucidity when it comes to that. But there's a whole concept of real estate wealth as well as illiquid wealth, so to speak. What is the kind of findings you have? I know you haven't been a big fan of real estate investment, so to speak, but there is a huge bent we have as Indians towards investing in real estate, as well as our idea of how much of that really contributes to our wealth. So like a house in a fabulous area in Delhi, for a lot of people means a lot more than having so many crores under management with so and so. Tell me how this whole scenario has changed, or has perhaps gone towards what you had initially said years ago, which is that real estate perhaps is not as golden as it appears.
Correct. Fatima, yeah, I hope it's not the reverse case for you.
It's definitely going to be, but not in crores.
She's a modest lady. She tracks markets day in and out. I'm sure she's made a lot of wealth. No. Coming back to the point, your liquidities is very critical. Real estate, of course, if a wealth advisor tells you real estate will not do good, people will take it with a pinch of salt, saying that he's supposed to badmouth real estate so that he gets money. But 5 years back we said that. But if there is a time when real estate can again do well, I would say it is at least 3-4 years away. Okay. And it is not so soon in India that it will come back in flavor. The second finding is that India has 60, if we all put all our balance sheets together, meet again after a week, we will get an average of 60% in real estate. That's the Indian high net worth individual investment in real estate other than the house you occupy, right? So globally it is 18%. Indians have some extra knowledge about real estate. I don't know where it comes from, but they have 60%. So either the foreigners are dumb or we are. Now, at least for the last 5 years, we have been proved dumber. But there have been situations where real estate has made money. We get very emotionally attached because it has made money. But the next 10 years is very different than the past 10 years. Just because Nifty made money last 10 years doesn't mean that it will make money next 10 years. But if I have a house which I bought at 1 crore, if it is 10 crores, it might not become 100 crores in the next 10 years.
Sure.
But I'll be so emotionally attached to it that I will never be able to let it go, because it transformed my 1 crore to 10 crores. So create liquidity. There are 2 stages in life. One is growth, the other is consolidation.
Okay.
In the consolidation phase, most of our clients are in the consolidation phase. Consolidation phase, real estate has very little relevance.
Okay.
So if you're in the growth phase, if you want to get to 30 crores, 40 crores, 50 crores, you've already got there, 10 crores, 20 crores. Now you say, let me consolidate and make life simple. Then real estate has not too much relevance. Real estate in India, 5 years back we would have told, again it is borrowed opinion, it was not our smartness, I'm being very honest here. Raghuram Rajan, who was the RBI governor at that time, made a super statement, very, very strong statement, saying that real estate is a bubble. I just copy pasted him and wrote an article on ET. He also said, fools will invest in real estate. In 2013 he has said. So when Raghuram Rajan, after seeing such data, in being in such responsible post, is making such statements, and it was not even highlighted. If he said the same thing about equity market, I would have got at least 500 calls next day. Feroze, you're such an idiot. Raghuram Rajan is saying it will go down, you're saying it will go up. For real estate, our love is so much that we can ignore anybody. right? That's, if you see the article, he says fools invest in real estate. Which RBI governor is going to make a reckless statement like this unless he has seen data? So, and the opinion is the next 3 years can't be. So what you have to do, you have to try and sell 10, 15, 20% lesser than the peak value, get it liquidated and put it on the path of growing, if not status quo. So that's the recommendation.
Okay. And just as I sort of end our part of the discussion, because I think we have a very a captive audience who's been listening very carefully, and I'm sure this is an opportunity for you to come back with questions. One more question that I want to ask you about is the whole idea of debt. And how wealth management is really addressing that with HNIs at the moment. Because debt, of course, is seen as something that is necessary, but at the same time, it can really be quite a bummer, so to speak. It completely depends on whether you're looking at it as an entrepreneur, or whether you're looking at it as an investor itself. How do you really feel, how much debt do you think should be weighing down HNIs, and how much diversification do you think also should be existing in portfolios going forward?
Very, very good question, Fatima. I think we should all be concerned about this question. And if there are a couple of points which you need to implement on your portfolio, whoever your advisor is, that's immaterial. Debt is something which you are lending money to somebody because you don't like risk. In the non-risky portion, if risk starts coming, then it hurts immensely. Where you're prepared to take risk, it is expected for equities to go up and down. When you lend money to somebody and he goes bankrupt, a AAA rated company, it's a wake-up call. Now what can you do? Firstly, if you have invested in debt, debt is nothing but lending to companies, is debt. So in your debt portfolio, you might have 5 mutual funds. You have to check inside the 5 mutual funds, how many bonds are there. If you don't already know it, that means you have not done justice to your money. You should have at least 100 bonds, at least 100 bonds. So to answer your pointed question, what is the right diversification on the debt side of the portfolio? If out of my 100 rupees, 40 rupees is in debt, this 40 rupees should be distributed across 100 different companies through mutual funds.
Wow.
Because in a mutual fund, there are 20 bonds, 30 bonds. So if you buy 6, 7 mutual funds of a specific nature, you should at least get 100, 120 companies. Even if 1 or 2 companies or even 5 companies go bankrupt in a very bad situation, it should not lose you more than 6 months return. If 6 months return goes away, I know my back will not break, right? I will still move on. If 50% of my money goes away, then my back is broken. I will never be able to overcome it. So that's the right amount of diversification.
Okay.
So 100 companies should minimum be there in any HNI debt portfolio. How do you check that? Your advisor should have already checked it, or if not, if he has checked it, not shown it to you, you should know how many companies you have lent money to, especially in a situation which is very, very shocking. Rating, to my mind, in India, I have not believed in them for the last 7 years. I have not believed in them, and I have been very vocal, at least on media, saying that I don't believe in rating. Of course, on recorded, I'm saying that it might not sound very good to some people who are in the rating business. Because, just look at this data, US is a very, very large country, the biggest country, biggest GDP. You know how many companies are AAA rated in the US? 2. Only 2 companies have been able to get AAA rating. In India, AAA rating has been distributed. 38 companies in India. Are you saying US corporates are significantly lower credibility than these 38 Indian corporates? I doubt that. So rating agencies in India have been far more generous. Reasons best known to people, not to me. So use something called Z-score. Okay, I'll just leave it at this word. Use Z-score. You are duty bound to take care of your money. Right? Now what can happen is you can say, I trusted the advisor. He gave me the wrong instrument. Yeah, there is also Mr. Narayan Murthy's proverb, which is so inspiring. He says, in God we trust. Everybody else, please bring data. Okay, so you can't say I invested on trust. You have to ask for the data. What is the Z-score of this company? I see people buying 1 bond Mutual fund is still okay because there will be 30 bonds. 2 of them will go bankrupt, you will still survive. It will not hurt you beyond 3 months, 6 months, 1 year. If you have bought a bond with your hard-earned retirement corpus, right, and we have not even checked the Z-score of that company. Z-score is invented by a person who in 1967, 52 years back, by a gentleman called Edward Altman. This is used as the most prominent method of checking whether the company is credible or not. And in fact, because I have been doing his prachar, I have been publicizing him, so we called him and he came down to India. Mr. Altman, Edward Altman is still alive and he's an 87-year-old man who is very wise. He came and did an event with me in Mumbai. So please use this Z-score to lend your money to any company. Who will calculate it for you? Either your current advisor. If your current advisor is not able to, then I'll be more than happy to do so. Because we have 3 people, thankfully Mr. Edward Altman has created employment in my company. 3 people only calculate Z-score. So if you wish to have any company's Z-score, you should get that computed. That will give you a better indication whether the company is strong enough to lend your money. So that's the second tip on the debt side. Diversify more than 100 bonds. We have to go check how many do we have currently. If there are only 60 bonds, you might want to re-engineer your debt portfolio. If the Z-scores, if you have individual bonds, like somebody told you, buy this NCD, buy this fixed deposit of a corporate. If you have individual, please calculate at least Z-scores for those individual, if not for the mutual funds.
Okay, and because I can't resist, and after this it is going to be open to the floor, one quick question to you. How often should investors be reviewing their portfolios?
1 year. You can monitor it every month. Okay. You should monitor it not more than every month. You should monitor it. You should meet your advisor once a month. Along with that monitoring, you should always keep the next in line in the room. The day I am not there, my wife might need to take over the portfolio. So she has to be there. Or if it is wife's money, husband has to be there in monthly meetings. So that in several meetings, 10 meetings, 20 meetings, 30 meetings, the other person is also clear and aware of what is happening. Otherwise, wife says, I am not interested. Sometimes husband says, I am not interested. Child says, no, I am a photographer, I am not interested. Yeah, it is not a choice. God has been kind to give you more money than you can spend, so it's your duty. It's not an optional subject. So point 1, you should monitor it every month. Point 2, you should definitely have, the day I am not there, who is the next guy? That next guy, the reason why I am the deputy CEO, and my CEO, who is my professional guru, 64-year-old gentleman, very wise gentleman, he has made me his deputy because you guys have all trusted your money with me as a company. So if he is leaving this company or leaving this world, which is possible, right? Of course, it's a certainty. We don't know the dates. Both of us will not be there. So there has to be the next in line to continue the strategy, right? You can't say this person is not there, so strategy will be new. So that's my second tip. 1 year, you have to do a full-fledged review, monitoring on a monthly basis. Don't ever monitor your portfolio because quite a few companies come and say, I'll give you online access. Check it every day. What do I do with checking every day? Yeah? Check it maximum 1 month. 1 month is also it's a reason for me to meet my client and appraise him rather than so 1 year strong reviews, full-fledged reviews in April are very critical of how the year went and why did it go the way it did. And monthly monitoring is good idea.
Very nice presentation. Good questioning as well.
Thank you.
Country has set an objective of becoming a 6 trillion economy. That's what we hear Honorable Prime Minister saying. Now, if you look at our growth in the last 4 decades, some people say it's moderate. Do you think this kind of a growth is enough for us to achieve 6 trillion economy? And all our investors, our wealth management is linked to this. Your opinion on that?
Yes, so fortunately we are one of the fastest growing this size economy. People actually don't realize enough that when this government came, we were the 10th largest economy. This year we are the 5th largest economy in the world. We have overtaken UK mostly this year. So it's of course growing at a very, very rapid pace relative to other people. So is 6 trillion possible in the next 10 years? If the rate of growth in the next 10 years needs to be 11%, if it grows by 11%, at least including inflation, it can grow. Okay, nominal GDP can grow, but the real GDP might not grow to 6 trillion, in my opinion. 6 trillion is a little aggressive. But what we don't need to actually grow, we need to bring the economy, which is the parallel economy, into mainstream. See, when US has a certain economy size, it is the full economic size, because there is not a large parallel economy of cash. In India, there is a huge parallel economy which is not being measured, which is another kicker for our economy when it comes to mainstream. And what will bring it to mainstream is GST. GST has the potential to bring it to mainstream. In the entire chain, now if there is a bottle of water, there is somebody who's doing the bottling, somebody is doing the printing of the label. If one person pays tax, everybody needs to pay tax. Earlier, if one person says, I will pay tax, he will go down the drain because everybody else will not pay the tax and compete with him. So GST has the potential over the next 5-7 years to bring the parallel economy into mainstream to a certain extent. So I am reasonably bullish that the economic growth will be there, and you are absolutely your point that our lives will be dependent on economic growth. You are right. Our lives in the short term are dependent on news, whether attack happens, retaliation happens, budget, what happens. In the medium term, markets and our lives are dependent on corporates. How much are they earning? How much are these big companies earning? In the long run, we are dependent all on the economy. You're right. But then comes the advisor. If he can give you an extra return, then that becomes your bonus.
You talked about the 4-month strategy to protect downside. Now, could you elaborate on that, or would our advisor talk about it? I mean, because it's, I think, very topical at the moment, and it's important for us to understand how that's going to be done. You know? Second question, just so I cover both. You also talked about the Altman Z-score, and the sites like Value Research, all of them give Altman Z-scores. Can I rely on them, or do you think this computation is fairly done differently by different people?
No, I would definitely rely on Value Research for sure. Of course, it's one of the person I know, Mr. Kumar. So Value Research is one of the most credible sources to get Z-score. It also gives you some other scores which are very, very important if you wish to be on the driver's seat and check. So Z-score, C-scores also it gives. So you can rely on Value Research Z-score. Z-score is a very easy formula. If somebody has the balance sheet, there are 5 components to it, X1 to X5, X1, X2, X3. You just have to put those numbers and the Z-score comes. So you can rely on that. You should not rely on the Z-scores completely on financial services company. For manufacturing company, Altman Z-score is the best method ever. For financial services companies, you can also use another method. So I'm putting my disclaimer. Coming back to the first question, is how do you create a 4-month strategy? So it's not a product. I will, rather than giving you a product, I'll tell you the formula of how you can achieve this. How can you protect your downsides and still be in the market without being worried whether elections can spoil my party and take away all the return I've made? Only for you, sir. If somebody doesn't interpret it, it's okay, because this could get a little technical. So what, like one client I had, he was very, very paranoid. And I said that this makes no sense for you to be so paranoid till May if you have your hard-earned money. So if you remove all your money, for example, this is not a blanket recommendation. This requires a strategy and specific understanding of the human being, which I don't of the group. If you remove the money from equity, let's assume this gentleman had a reasonable exposure to equity, that's why he was worried. You remove the money. Let's assume 100 rupees is there in equity, you remove it. So is it now protected? Of course, you've removed it. But the problem is, if market goes up, you're not in the game anymore. You have left the market. So you remove it. Now when you remove your 100 rupees, what can you do with your 100 rupees? You can put into fixed deposit. Of course it is very safe. But now you have nothing to do with the market. If you have nothing to do with the market, if Modiji comes back to power and the market goes up 30%, you've lost all the 30%. So you should not do that. You should take the money out, put that into fixed deposit. Step 1. Will fixed deposit give me 3%, 4% return for the next, till the budget time? Till June it can give me 3-4% return. Till June. This is 4 months, whatever. Add 1 more percent to it. With 4 or 5%, you can buy something called a call option. You can buy a call option. Call option means, okay, it's very simple. It's not as complex. So what did you do? Step 1, removed your money from equity. Step 2, put it into fixed deposit. So now your 100 rupees is very safe. You take the return which you are expecting from the fixed deposit, not your capital. Take 1 rupee from your capital. So 4 rupees is from the return, 3-4 rupees is from the return, 1 rupee is from your capital. Take that money. Now how much money do you have? 5 rupees. With this 5 rupees, what do? You buy a call option. What do you mean by call option? It is very simple. I took my 5 rupees, buy a call option. With this 5 rupees, if the market goes up 30 rupees, you will get 30 rupees. If the market goes up 20 rupees, you will get 20 rupees. Call option means how much ever market goes, I will give you that. If the market doesn't go anywhere, the entire 5 rupees is gone. But you still have your 100 rupees here. If market goes down, what happened to your 5 rupees? Everything is written off. But I still have my FD, which is 99 rupees. So if the market goes 30% down, what will you lose? You will lose 1%. If the market, then if it goes down, what will I do for my client? I will take the 99 rupees and buy the same mutual fund at a cheaper value. Understood? So step 1, remove your money. Step 2, put it in an FD. Step 3, take the FD return. Take also 1 more percent, which is your cost. Buy a call option, step 4, and then just relax. In June, if the market is 40% up, you will get 40 from the call. You will get 40 from the call, 99 from the FD. How much did you get? You get 139. You got 1% less than market, which I will be okay with. But if the market went 40% down, your 99 in FD is there, 5 rupees of call option is down the drain. So call option price is as little as 5% for June. And now who will give me this call option? Anand Rathi is the largest provider of derivative on the exchange. So on the exchange you can get this call option for any amount, for as little as 50 lakhs to as much as 1000 crores on any given working day before 3:30. So it's a practical suggestion, it's not an academic suggestion. So if somebody has not been able to interpret it, it's fine. But call options are very simple instruments. You put some money, if it goes up, you will get the entire return. If it goes down, you will lose everything of this 5 rupees. But you still have your 99 rupees safe.
If I want a higher return, I'm sure the risk value goes up.
Correct.
That risk value, I'm sure, is based on my portfolio.
Correct.
Who does it for me?
So sir's question is, I mentioned the number 8. 8 is called the standard deviation. I was not wanting to use this word too many times because it generally we use in finance. The biggest problem is they find the most intimidating names for the most simplest concepts and scare everybody away so that finance professionals have a job. Okay, that's why we have such tough names. Standard deviation is nothing but, okay, and I'll come to your question, sir. So why is standard deviation important? Like sir's question was 15, you are saying. Is 15 a constant? No. 15 is not a constant, it's a variable, it can vary. So if I say 8 standard deviation, it means that 15 plus 8 to ala, 15 minus 8 to amamudio. Okay, so I'm just practicing my Tamil with this audience because it's been some time since I've been using it. So 15 plus 8, 15 minus 8. So 8 tells you the propensity of the swing possible. The more the number, like there are PMSs where I've seen 20 standard deviation. That means it can be 15 plus 20, it can be 15 minus 20. That is also not the full range. Full range is 3 times. That means 15 plus 8 plus 8 plus 8. 15 minus 8 minus 8 minus 8. This is ideally the full range. If 2008 to the power 4, 2008 was a very bad year. If that happens, Your range will be not 15 plus 8 minus 8. 15 plus 8 plus 8 plus 8 or 15 minus 8 minus 8 minus 8. So these are called ranges 1, ranges 2, ranges 3. Now coming back to your pointed question, sir. So if standard deviation was 0, then sir's belief that 15 is a guaranteed number would be valid. So my standard deviation is not 0. It is a range in which it can operate, and that's why sir has in the bad year made only 3.5. Now coming back to sir, Nifty standard deviation is 13. Last 3 years, Nifty range is 13. My aspiration is to keep it at 8. So the swing is lesser than the biggest index of the country. Nifty is the biggest index of the country. If my swings are lower than the biggest index, then my clients will have a low anxiety life. Right? So, does that answer? So what was your pointed question? I missed it. Sorry. So 8 is. Okay, who gives me the risk? Exactly. Sir says now I don't want 15. I want 18. I want 20. What is the risk I will have to take to get 18 or 20? Okay. So that comes from the Markowitz theory which I told you. Okay. You should Google this out. Because there's this, see friends, it's not so tough. If you just Googled it, the information is there. Markowitz theory or capital asset pricing model tells you to get 20, what is the least risk you should take? It tells you, Markowitz. That's the third level of mathematics I was speaking to you about. It is also called CAPM, capital asset pricing model, or it is called Markowitz. They are very, very simple theories. Okay, even if you don't understand, but if the usage of it is applicable to your money. So, if you are getting 20, with a very high standard deviation, you should not take that 20. Okay, now for example, when I manage Mr. Rathi's treasury, the objective is, Mr. Rathi says, I don't want 15, I want only 12. His risk target is 3, like I told 8, na? His risk target is only 3. So he wants a very narrow swing, 12 plus 3, 12 minus 3. So, for every return, there is one risk. More than that, you should not take. That's what Markowitz tells you.
My only question is, most of us are 45 plus, and the normal theory says 100 minus your age should be equity versus debt. Is that whole good? That is one. Number 2 is, what would be the optimal mix of small cap, mid cap and large cap funds?
Point 1, sir says, people tell me age, 100 minus my age should be my equity. I don't think it is valid for all of us in the room. For a person who is a service class, who has not created extra money, which he can't use, it is valid. It's a good thumb rule. Why are thumb rules produced? Because a person can't afford an advisor. Right? So you need to give one thumb rule so that without anybody's advice, he still is on the reasonable path. See, now one of my client has 22 crores. Giving an example, very close client of mine. I know that he lives a very modest life. Like most of us in South India used to live a very modest life, unlike Delhi, Fatima.
God.
That's an attack on Delhi.
What an accusation.
So Fatima is from Delhi, so I thought, so when he's living a very modest life, I don't think he's going to use most portion of his money in his life. He is 83 years old, right? But the money is earned by him. But is it going to be spent by him? I think it is his grandchildren's money. It is in his custody. Today it looks like he is the owner, but he is not the owner to my mind. He is just the custodian, right? He is the custodian of the grandchild, because the child is also well settled. He is in the US, he is making so much money. So his child will not need the money. His grandchild is whom this money will go to. So the question is, should the strategy be of this client, or I should look at his age or his grandchild's age? I would look at his grandchild age, because today he is the karta over a period, because his every month income is 25 lakhs from this, approximately. Not every month staggered. If he's earning 25 lakhs in a month with his 22 crores, he is not spending more than 1 lakh, 2 lakhs. So it's unlikely that he will touch his capital. It will go to his grandchild. So it should first, the asset allocation should depend on who is the owner. Sometimes it might look like the person whose name it is the owner. He is not the owner. He is only the custody keeper. It's going somewhere else. So that's your question to answer. Question number one, answer to the question. Question number two, mid cap, large cap, small cap, badi company, choti company, small company. We should allocate it on the basis of the second formula I was speaking about. And that formula, to my mind, is a very, very good formula. And I use least judgment of mine. Mid caps, like sir said, small caps can do once in 7 years, they do wonders. So they always command an extra price. They command an extra premium. Right? So if Nifty commands 20, if Nifty commands 20p, forget the word p, Nifty commands 20, mid caps ideally command 8 more. How much should mid cap command? 28 price. If 20 rupees is Nifty in the form of p, how much should mid caps ideally command? 28. But 1 year back, when Nifty was commanding 20, mid caps were commanding 40. So the difference was how much? 20. Ideally the difference over the last 15 years is how much? Only 8. That means mid caps have gone far ahead than they deserve. So if the difference is 8, no problem. If the difference becomes very big, you should not be in mid cap. Today the difference is 13. It is still more than the long term average. Still there is some more pain in mid caps possible. So for whoever didn't understand P, it doesn't matter. So Nifty commands 20, mid cap should command 28, but they were commanding 40 1 year back, is why I said mid caps are overly expensive. Now they are commanding 13, average is 8 difference. So still there is some froth in the coffee before you drink it.